Hello, this is Mel Thompson, and this is a podcast and a series of podcasts about political risk. Today we'll be discussing the silent consequences of the EU debt crisis. The EU debt crisis has had a consequence, one that the average person did not see coming and certainly did not expect. No one speaks about this because it is now becoming much more of a problem that could impact markets in an adverse way. Impact the markets in a way that is based upon the uncertainty of what will happen if, in fact, the EU is unable to expand its own investment possibilities for their own people in other global regions. Now, this doesn't sound like something that would necessarily be a problem for U.S. companies or U.S. foreign direct investors. However, it is a problem because without growth, the kind of growth that would come from these types of investments, the EU is a much weaker place and less of a more reliable partner that can be a hedge against losses that foreign direct investors and companies may experience in other regions such as the African continent and parts of Latin America. Now, the inability of the Eurozone and its nations to look at the bigger picture when it was getting into all the problems since 2008 with the financial crisis was something that no one anticipated being still around as an issue in 2015. The lack of vision is something that was the devil in the details with the EU from its inception. However, the big picture also requires the vision to understand that the consequences and the domino effect of your own financial ineptness will eventually come back to haunt the same people who are putting money in your country, and that's where we're at right now. Now, the recent European Union meeting with the community of Latin American and Caribbean nations is right on the heels, right after one that was hosted by China, where it placed $250 billion in investment in about 10 years to Latin America. Now, needless to say, the EU was watching this with some degree of apprehension, as were U.S. foreign direct investors and companies. In essence, China was entering a market in the backyard of the U.S. foreign direct investor, a backyard with 33 nations. In no way is this a minor incident for the U.S. or the EU. In fact, it is a clear sign that increasingly the EU is being marginalized by its own inability to clean up its financial house. This is not a good sign for foreign direct investors who are looking to the EU as a backstop against losses they may incur on the African continent and elsewhere globally. In fact, what you're looking at is a two-headed monster of uncertainty created by the inability of the EU to see this coming. And on one side, you've got the Russians rattling the Soviet-era sabers and undercutting the EU with political contributions to right-wing politicians within EU nations. And on the other side, you have China creating new markets for itself without any fear of being outbid by the EU. A weak EU created by these silent consequences, the silent consequences of the mess that was bubbling up since 2008 within the mess within the mess of the financial debt crisis in the EU. That particular silent consequence is the one we're seeing right now. The financial disarray that has ravaged the EU since 2008 is now the opening that China has always needed in Latin America. If the money is not being made and jobs created in the EU, then the U.S. foreign direct investor has one less place to go. Unlike nations on the African continent and in Latin America, the EU has always been seen by investors and companies as a more reliable and stable place devoid of large and uncertain types of political risk that you would see in other parts of the world. Not all, but certain ones. And there was more certainty and understanding of how business would be done in those countries of the EU as opposed to some project somewhere on the African continent or in Latin America that may be impacted by other types of incidents that cannot be calculated. The incalculable types of political risks, such as ethnic hatred, violence created and splinter groups within that violence. These types of things that impact foreign investors, projects, and companies were not large swaths of political risk that you would see in the EU. Therefore, it was a much better place to be invested in as a hedge against any losses you would incur in other parts of the world. Now that's gone. The inability to use the EU as a bank, shall we say, an investment bank, is something that is now the silent consequence that is now bubbling to the top for foreign direct investors in the U.S. and in other countries. Companies are now going to be feeling the impact of this, and the fact that the EU is scrambling to do something, and the fact that China decided it was a good time to promise $250 billion to these Latin American nations is a clear indicator that something is certainly not going right for the EU, because they cannot step up to the plate and outbid the Chinese. It is nothing that the foreign direct investor in the United States can do about that, nor can any of our companies or even our government. This was the silent consequence that was possible yet not expected. U.S. companies and foreign direct investors will now be in a stiff competition with China, Chinese companies, and their investors in Latin America because of the financial problems of the EU. Competition with the deep pockets of China in your own backyard will not lower cost, only increase it. This has been Mel Thompson.